Hello everyone. Let's break down today's market using three key charts: 10-year Treasury yield, TNX, Nasdaq via QQQ, and S&P 500 via SPY. Today is not about headlines hype, it's about reaction, positioning, and what the market is actually pricing in right now. We're seeing a classic tug-of-war between rates, risk appetite, and short-term positioning, and the charts tell this story very clearly. Let's start with the most important driver today, Treasury yields. Looking at TNX, we see yields pulling back slightly after a recent push higher, currently trading around the 4.27–4.28 area. This move is important for two reasons. First, there is no breakout. Despite recent volatility, yields failed to hold above the 4.30 zone, which remains a key psychological and technical resistance. Every time yields approach this area, we see hesitation and profit-taking. Second, this is not panic buying in bonds. The pullback in yields is controlled and shallow, which tells us that the market is not pricing an aggressive recession scenario, but rather a temporary cooling after an extended move. What does this mean for equities? Lower or stable yields give short-term breathing room for growth stocks, especially tech. However, the fact that yields remain elevated overall means the market still respects the risk of higher longer rates. In simple terms, TNX is pausing, not collapsing, and that creates a window for equity bounces, not a green light for aggressive risk-on.
Now let's move to QQQ. QQQ shows a strong intraday rebound, recovering after earlier weakness and pushing back above the 610 level. This move looks impressive on the surface, but context matters. What we're seeing here is short-term relief, not structural trend change. Why? Because 1. The rebound comes after a sharp sell-off. 2. Volume does not suggest strong long-term accumulation. And 3. Tech remains extremely sensitive to any movement in yields. This type of price action is typical when short sellers cover positions, dip buyers step in for quick trades, and algorithms react to stabilizing bond yields. Important detail: QQQ did not reclaim prior highs, and price remains below key resistance zones formed earlier this week. So what's the takeaway? This is a tactical bounce, not confirmation of a new uptrend. As long as TNX stays elevated, Nasdaq remains vulnerable to fast reversals. In other words, tech is bouncing, but still on thin ice.
Now let's look at SPY. SPY shows a measured recovery, tracking closely with QQQ but with less volatility. Exactly what we expect from broader market exposure. The S&P is holding around the 680 area, bouncing from intraday lows, but again without strong momentum. What stands out here is market balance. Unlike tech, SPY reflects defensive sectors holding up, rotation rather than panic selling, institutions staying active but cautious. There is no sign of capitulation, but there is also no aggressive buying pressure. This tells us one thing clearly: the market is waiting for clear direction in yields, confirmation from macro data, or a catalyst strong enough to break this consolidation. SPY is acting as an anchor, stabilizing the market while traders fight it out in tech.
Let's summarize today's message. TNX is cooling, not breaking down. Rates remain the key risk factor. QQQ is bouncing, but this is short-term relief, not trend confirmation. SPY is stable, signaling consolidation, not fear. The market today is not bullish, not bearish, it's tactical. This is an environment where chasing breakouts is dangerous, over-leveraging is punished, and patience and discipline matter most. Until we see either a clear breakdown in yields
or strong confirmation in equities, expect range-bound, fast, and unforgiving price action. Thanks for watching, and as always, trade the structure, not the noise.